Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, and this is the Russell 2000 ETF, ticker symbol IWM. If you recall, last week I drew these zip lines, as I call them. These are basically the forecasts that I make each and every week. And last week I said that the IWM would most likely drop and then bounce and start to move up. Now, the end of this line right here was my target, and we did not hit that. We missed that just by a hair. But what did happen on Wednesday is that we filled that gap precisely to the penny. Now, if you're following my gap fill rules, you know that 80% of the time, that's what happens. Gaps fill. But then after the gaps fill, we then have an 80% chance that the market will reverse from that gap fill point. And that's exactly what's happened. Now, what does that mean for next week? Well, I'm going to have to back out of this chart a little bit and give you some feedback on what I think is happening. If you look down at the bottom of this chart, right here is the June lows. And what I think we're going to see next week is I think we're going to see a little bit of a rally, not much. You could almost feel the heaviness of the market this week, right? You could feel how they tried to rally it. Monday failed, closed down. Tuesday tried to rally it. Wednesday we had the best day of the week actually, but then it failed to stay at that higher level on Thursday. And you can see that we had a bearish harami yesterday. A lot of confusing signals or conflicting signals. This looks like a hammer pattern. This looks like an inverted hammer. But look what's happening down below. The stochastics is starting to hinge lower, and the volume is increasing on this red candle. So coming into next week, this is what I think we could see. A slight, just a very slight rally. It's the opposite of what I thought we would have happen this week. We're going to see a rally, and then I think we're going to break out below the June lows back here. Again, going back to that low right there on June 16th, I do think that next week we're going to close below that June low, and then we're now on the hunt for red October. This is a very critical point in time for our markets, as you'll see from the geopolitical events that occurred this week starting Monday and throughout the week. There's a lot of pressure on the markets right now. There's a lot of uncertainty among investors and even fund managers. And we're going to have to see how intense this gets if we break out below the June low right here. So my upside target is 169.42 to the upside, basically testing the highs from today. And then I think we're going to go lower, 159.69. Again, a lot of that hinges on this gap fill because 80% of the time after gaps fill, it reverses, like I said. And there are a lot of stops that are building up under this June low because if anyone bought it back here, any swing trader bought it back there on this bullish harami right there, they're putting their stops below that support level. And as time builds, they're trailing their stops below lows. And we have a whole bunch of stop loss orders built up below that low right there. And so as we move into next week, if we break out below those lows, basically the stops will be triggered. And that's like a slew of sell orders being entered into the system. So keep an eye on the charts for IWM. Now, if I look at SPY, you'll see that we also tried to rally right up on Wednesday, did not hit that target, and we actually missed that gap fill point. We had a couple of comments come out on the YouTube page that were questioning that exact fact that the gap did not fill. Are we going to go higher? Are we going to go lower? Well, here's where the rubber hits the road. You know, it gets very difficult when the signals start to move against one another. Like we see here, it's almost a inverted hammer, but now we have a higher volume. We just had a buy signal cross on the stochastics, and now look, it's hinging right back down. We had a buy signal in the CCI, and now that's heading back down. And guess where that's all happening? Below the June lows. So what's happening right now, see this jump in volume right there, could very well be stop loss orders being triggered and the selling intensifies. I mean, look at the intraday chart on this one. This is pretty incredible. Look at the minute by minute right up until the close. We had selling pressure come in on fairly high volume. You see that? Look at this selling that occurred towards the end of the day. We closed right on the low, and look at that big volume spike. So there's a lot of folks that don't want to be holding long positions over the weekend, and a lot of them are managing risk. So again, we did not fill that gap, but that gap fill point now is going to act as resistance if we even get back up over the June lows. So what does that look like for next week? All right, because of that increase in volume, I think we're going to start to move lower into next week. I'm not going crazy low on that, $350.66, and then we might even see a little bit of a bounce and test this now as resistance, because remember, once support is broken like we see here, it turns to resistance. This is what I talk about all the time in this little zigzag pattern. Once support is broken, it turns into resistance, and this is a textbook role reversal. So again, for next week, my downside target is going to be 350.66. Take note of that. Watch it, follow along with the charts, and of course, if you're long, holy mackerel, I hope you're using risk management strategies that work for you. Our option traders are now in a negative delta position. We want the markets to go lower. We're making money. We have really good positions that are stacked up to the downside, and I'm very happy for our Option Oracle members. And now let's look at the VIX, because this is extremely interesting. The VIX last week was closing on the highs, and then what happened? We had a hanging man on the VIX after this long shadow from last Friday. We had a hanging man. We had a close to a spinning top right there. Then we had this bearish engulfing candle. Look at that massive bearish engulfing candle. And then we were followed with a bullish harami. Isn't that interesting? That doubled. Again, conflicting signal. It doubled as a shooting star. Now what do we have? Well, the VIX has a lower high as of today, Friday, the last trading day of the quarter. We had a lower high, lower low. And so we might see a little bit of a downtick on the VIX, and then I think we're going to go higher. So I'm just going to do a little bit of this, a little bit of that, and I'm projecting out here into October 9th, right? So I'm expecting the VIX to go right back up after it pulls back just a little bit. And again, I say this all the time. For the most part, the VIX is inversely related to the S&P. So you might think, well, if the VIX is dropping, doesn't that mean that the spiders will most likely rally? It could happen, but it's not always the case. I'm just reading the technical signals as I see them on the charts. Try to keep my opinion out, except when I start talking about geopolitical events, then I'll let my opinions work their way in. That is totally up to you whether you agree or disagree with me. I'll leave that up to you. But I'm just laying out the facts for people, and that these events that we're seeing, especially this week, will most likely affect the market. And if investors get fearful, that will be reflected in the VIX, because it's also known as the fear index. So my downside target on the VIX is going to be 29.75 and then right back up to 34.42. All right, let's take a look at the tech sector represented here in QQQ. This is the ETF that basically tracks that tech sector. And look what we have. Again, this makes it very, very difficult to forecast when you have these conflicting signals. Look what happened. We did fill this gap. Remember what I was talking about last week? Chances are the gaps will fill, start to reverse, and then I said, watch out below, buckle up, right? That's exactly what's happening. Look, the gap filled. We had a bullish engulfing candle, and it failed. When you have a bearish engulfing candle that most of the time works out 80% of the time, and if it fails 20% of the time, that failure causes the buyers to quickly get out because they don't want to be holding onto a failed bullish signal. So what do we have? Yesterday we had a lower high, lower low. Today we had a lower high, lower low. But this is the big deal. Even though that looks like an inverted hammer, which is normally bullish, we had that close again below the June low support level at 268.73. And although that's a slightly lower volume, I do believe that we're going to pick up some steam into next week to the downside. So my forecast is going to be just that. I'm going to say a little bit lower. We might see a bounce at this new resistance, right? Remember, former support turns to resistance. So 268.73 is going to be resistance there. My downside target is going to be 260.23. And then we're going to have to monitor that resistance to see if it holds. And again, this is where the rubber hits the road, so to speak. You have to be following the technical signals. Again, coming into October, a close below that low, well, the stochastics is making another turn lower and the CCI is hinging back down. Again, that makes it very interesting. Just a quick note, if you look at the high-low list, which I'm putting a link to this page in the description box, look at the New York Stock Exchange. We had 6 52-week highs and 486 52-week lows. It's not as intense as it was last week, but that's pretty bearish. The breadth of the market is extremely negative. It continues to be negative. Got to keep an eye on that. Now, on the NASDAQ, we had 52 52-week highs. And what happened below there? 52 52-week highs and 595 52-week lows. 10-to-1 ratio. So again, the breadth of the market is extremely negative, and I'll be putting that link in the description box for you. All right, so again, that downside target, again, is $260.23. Watch out below. Now, the diamonds, this one didn't even come close to my target. Didn't even come close to filling the gap. It tried on Wednesday, like the rest of the markets. But look at that. We closed right on the low on higher volume for the diamonds. Now, here's the June lows right there. Look what's happening already. That June low was broken. And on Wednesday, as we attempted to fill that gap, that June low, which was support, is now acting as resistance. So that's already happening. And I think the rest of the major markets are going to do the same exact thing as we break out below those lows. So I'm going to erase that line, draw my new line to the downside. Going to have to condense that price axis there. I think we're going lower. Now, again, I'm not going crazy low like before, 282.32. And then we're going to have to see whether or not we retrace back up to that resistance line, because now we have that rubber band effect happening there between the price and moving average. So that rubber band is getting stretched. I think we could see another stretch in the divergence from that moving average on Monday and Tuesday, especially. So that is the target. Again, 282.32 with the oscillators now hinging back down on the diamonds. Now, we were talking about this. If you go back and look at the weekly market report from last week, right around the 4-minute mark, I was talking about a pullback possibly to fill the gap. And again, it made that attempt, but came right back down as it hit this resistance area. And I said, we'll most likely break out below the June lows. And that's what's happening here. It did not even try to bounce off of that support level. Now, I just want to do a quick shout out to Dr. Billy Price and his investment group, the Conover Investment Group. Thank you so much for sharing the video with your fellow investors. And this is how we grow the channel. If anyone is listening and is part of an investment group or investment club or trading club, put it in the comments box down there, and I'll do a shout out for you as well. Maybe it'll help your group grow if that's what your intentions are. But it's really from people sharing, liking, commenting, and subscribing. That's how this is growing. And we grew another 10%. We're now well over 11,000 now on a regular basis. And it's very exciting to see that. If you like it, chances are you're going to share it. If you don't like it, well, guess what? You probably won't. Some people are saying, why don't you stick to the charts and less to the conspiracy theory? All right, I get that. I have an opinion. You have an opinion. But I'm telling you right now, these aren't theories. These are facts that I'm bringing out. And you can see right here, this is something that happened on the 27th of September. Now, I'm going to go through this as the news broke in sequence. Now, remember I was talking about natural gas, how I like energy sector. Well, this, believe it or not, is not just sabotage. This would be considered an act of war. There were 3 different sections of the pipeline where explosives went off and ruptured the pipeline. Now there's methane gas coming out through the surface of the water right here, and it doesn't look like this is going to be repaired anytime soon. Now, again, connect the dots, because I do believe, as scary as this sounds, I do believe that we are moving closer and closer to a major war. I don't want war. You don't want war. But it seems like the globalists out there are pushing for war, the warmongers. All right, again, it doesn't matter what political flag you fly, please connect the dots and look where we're going. The market is not going to like this if it continues to escalate. So this is step number one, came out on the 27th. Right after that, what happens? The day after, the U.S. Embassy warns Americans to leave Russia. Remember, Russia had the referendum over the weekend. They now voted on that, and it looks like those states are going to be joining Russia, right? So this is, again, a sequence of events. We have this on the 27th, this on the 28th, then bam, what happens on the 20th? Same day, the White House is announcing the possible departure of Janet Yellen. Why is that happening? You have to ask that question. It's a very important question, why? Well, I think Janet Yellen and a lot of the other Federal Reserve folks that are associated with the Treasury Secretary here, I think they know that we're headed for a crash. I really believe they know it, and they're painted themselves in a corner. And the way I see it, I don't believe Janet Yellen is going to want to have her name attached to what could be one of the greatest crashes in our economy and the stock market in U.S. history. That's how I feel. It's the way I see it happening. I'm looking at the charts. I think that we could even go below the March 2020 lows. Well, I have that as a target. I think we could actually go into that. I'll explain a little bit more towards the end here. And then we have right there on the 29th, yesterday, OPEC is talking about cutting production. Now, what do you think that's going to do to oil prices? We've already depleted our emergency petroleum reserves, and OPEC is talking about cutting production. Well, the U.S. is going to have to buy back the oil to replenish the reserves. They already talked about buying it back at around 80, and I had one comment coming, oh, it's below 80. Why aren't they going higher? Why isn't it rallying? Well, you just watch. Watch what happens after the elections, especially. OPEC cutting production. We have to buy back the oil. It's going to create more inflation down the road. Although they don't measure it, they should measure it. They used to measure it. They don't. Why? Because they want to make that inflation number look a little bit more digestible for the Americans. Well, guess what? We're smarter than that. We see the prices at the pumps. It has been dropping because they've been pounding the price and they've been releasing that supply into the market. But again, after the elections, I think they're going to let it run. And you'll see it happen right at the gas pumps. All right, now what's happening here? Well, this came out today. Ukraine is applying for NATO membership. Now, why is this a very bad thing? Well, if NATO allows Ukraine to be part of NATO during a conflict, you're just begging to be in a war right there. This is the most outrageous idea and news that I've seen all week. This could very well put us into a World War III, and I'm not exaggerating in the slightest. If Ukraine is part of membership, there's going to be a war, and NATO's going to be brought into it. We'll be brought into it, and we cannot afford a war. No matter which way you slice it up, we cannot get involved in this. We shouldn't get involved in this. In fact, the NATO Secretary General came out with this, and look at these bullet points. I mean, just look at bullet point 1 and 2. Stating NATO is not a party to the conflict, but then in the same breath almost here in these bullet points, NATO supports Ukraine and will support it for as long as necessary. Well, if NATO is in war with Russia and we're now supporting Ukraine, well, you're basically entering into this war just by allowing them to come in. They also condemn the annexation of Ukrainian territories. Well, guess what? There was a referendum. The people voted to be part of Russia. And now they're blaming Putin here as the culprit for the war, right? Keep going on. Read into this, folks. Again, connect the dots. Use your gifts of discernment. Understand what's happening. Apply that to what can happen in the market. Adjust your investments accordingly and using good risk management skill, because the way I see it, this is my opinion now. It's not the opinion of Market Rebellion or anyone else. You saw that at the very beginning. This is the state of our union. In fact, no one wants to even talk about recession. Guess what? We're in a recession. We are seeing inflation. We will ultimately, again, in my opinion, see stagflation, which is going to make this much worse. Something along the lines of what we saw in the 70s. We have open borders. People are coming in by the millions. It is stressing our economy. As a result, there's a labor shortage. Why is there a labor shortage? You think, well, all these people wanting to find work. There's a labor shortage because people want to stay home and get paid to stay home. And they're hopping from one company to the next for a 10-cent raise per hour. Believe me, I'm talking to business owners, and this is a fact. This isn't conspiracy theory at all. Talk to anybody who owns a business, and they're going to tell you there is a labor shortage. We have a weakened military. Remember, back in COVID, a lot of our military members left because they didn't want to be forced to take a vaccination. The military is weakened right now. You don't believe me? This is a fact. Go talk to any Army recruiter, Navy recruiter, and they'll tell you they're not meeting their quotas. Again, step into any enlistment office for any branch of the military and talk to them. They're a leading indicator here. It'll prove this fact. We have depleted emergency reserves, as I mentioned. We're in a bear market. Can we afford a war right now? No, we can't. And then you have state governors that are adding to inflation. How are they doing that? Well, here, this came out today. This is not just the only governor that's thinking about this. They're sending out more millions of relief checks starting next week. What does that do? Who's going to pay for this, folks? You're going to pay for it, the taxpayer. What does this do to inflation? It doesn't slow it. It adds to it. It accelerates the inflation rates. And that's what we have going right now. And you have to look out the window. Look at the price of oil. We're bouncing off of this key trend line right here. See this? Let me go back and look at the monthly chart. What's happening in oil? We have an accelerated upward trend. Here we go. 4 red candles in a row. Drop in volume this month. This could very well be a pivot point that leads us into October, November pivot. And then, like I said, after the election, I think the oil is going to start going through the roof. I want to answer some questions here and thank those folks that are contributing to our comment page. Again, from last week, we have a lot of folks submitting comments. We have almost 300 comments coming in. Let me just highlight Rich Wilson here. Thank you, Rich, for submitting these questions. You say, hey, Jay, great stuff again. The SPY did not hit the gap fill before turning down. Now, remember, I talked about that in this video. And your question is, does this mean it missed it for the cycle as the volume is now heavily downward? Or should we expect it to fill before the leg 3 down? Now, I believe that we are not going to fill that gap because the spiders, and again, as we break out below those June lows, that area of former support is going to turn into resistance. Natasha, also similar question. Hi, AJ. We had the big bounce yesterday, but not to your targets. Exactly. We did not hit that target. We hit resistance. Today sold off. Are you going to keep your upside targets for next week, or you think we won't hit them at this point? I do not think we're going to hit the upside targets from last week. You say, I know you're negative delta, so your upside targets could be modified. I am modifying my downside targets now, not my upside targets. I'm modifying my downside targets to go lower. Again, I think October is going to be a red October, and our option traders are geared up for this bear market. Remember what I talked about? We are fully in to phase 2. Phase 1 ended on the pivot. We ended this month on a red candle. Now we're moving into phase 2, which is a more accelerated downtrend. Then a possible bounce. Phase 2 ends right here. Phase 2 looks just like that. Phase 1 is the start of that pattern. Phase 2 repeats it. Phase 3 is even more intense on the downside. And then a possible bounce. Where does that bring us? I think phase 3 will bring us to the 2020 lows. Now, I'm going to make a statement that is going to go out there for a couple of year forecasts. I believe that this could be the first time in U.S. history where we will see a phase 4. Again, Dow theory shows phase 1, 2, and 3, with phase 3 ending in capitulation. I think we're going to see capitulation in phase 2, which will drive a phase 3 harder to the downside. And then we'll have to see whether or not the March 2020 lows hold. If they don't, guess what? Support turns into resistance, and we could very well see a phase 4. Where does that bring us? Well, let me tell you, this is not going to happen overnight. Look straight down, and you're going to see that brings us well into 2024. Right? 2024, this does not happen overnight. So if you're learning how to trade options, congratulations. This is how we make money on the way down. by bearish strategies, using options. For those investors that are buy and hold and refuse to go to cash, I'm going to tell you, you could still use options to protect your downside. That's what puts were created for. They're insurance policies. Learn about that. Just don't hop in and start trading them. Take a couple of courses with Market Rebellion, and I think you'll be able to sleep better at night. So that's it, folks. Have a great weekend. We'll talk to you next week. So long.
As traders, we are beholden to forces greater than any one person. Forces that can lift spirits or leave scars. There are those who passively resign to their fate, leave their decisions to others, and let the chips fall where they may. And then there are the rebels, a battle-tested team of expert technical analysts, astute educators, tactical momentum traders, crypto connoisseurs, and the select few who take the market head-on so that they may have a say in their own destiny. Guided by the mantra, discipline dictates action. Discipline dictates action. Discipline dictates action. Today, we rebels gather, a community of mavericks, forging a path through the ups and downs on our own terms. Welcome to the rebellion.